Hello and welcome back to WION World is One. I'm Kanishka Sarkar. Well, on paper, India's economy is booming and local numbers look massive. But in the global market, India is hitting a massive wall. At the same time, US President Donald Trump just shocked the world by saying, "I love the inflation." This as prices hit a 3-year high due to the war with Iran. Today, we'll decode how global wars and a bleeding rupee are impacting your wallet. Joining us today is Dr. Suyash Bhatt, Director at Academy for Finance, Technology and Innovation. Dr. Bhatt, thank you for joining me on WION today. Firstly, let's talk about the global scenario. Donald Trump just said, "I love inflation," after US rates hit a 3-year high of 4.2%. Why would any world leader say that they love rising prices when the common man is actually struggling to buy groceries?
It's very interesting, actually, perspective that Donald Trump has. In a way, from an economics perspective, if you have inflation, that also leads to some growth. But at the same time, as you rightly said, if your grocery prices are going up, from a politics perspective, it's not a good news. But be that as it may, from his perspective, I think he's just trying to justify the current statistics that have come up. And this will also make it difficult for the Federal Reserve to increase or decrease rates going forward. So, there's very little that he has under control currently from the things which are causing inflation, whether it's crude oil price or demand supply gap created due to tariffs.
Right. Now, Trump's claims inflation will come down like a rock once the war with Iran ends. And he's mentioned secret operations involving oil and ships. But is global inflation purely driven by just this conflict, or is there a deeper economic issue at play?
So, in a way, he is right, because currently the entire world is fueled for inflation due to energy crisis. And once the energy problem is solved due to the Iran war, the inflation should go down. And you can see that in crude oil prices. Crude oil prices have gone down to 89.95 barrels today. So energy prices going down is always a good news, and it will solve the problem. But the demand supply gap which is created due to tariff may take much longer to fix.
Okay, so that's about if prices continue to remain slow down actually. But if the US-Iran war keeps the oil prices hovering around those $85, $90 a barrel level, how does that amplify India's currency trap? Do you think India is essentially paying a domestic price for a foreign war?
Yes, in a way it is correct. It's not our problem. It's not something which our government has created, neither our economy has created, but we have to face the brunt of it. Because India imports 80% of energy from external sources. So you will be impacted by higher crude oil prices. And the only saving grace is if the war stops tomorrow and the crude oil prices go back to maybe 60, 64. That's something which would change everything from a geopolitics and economics perspective for India. The rupee may suddenly start appreciating. Everything which is looking negative may suddenly turn positive. If energy price is correct, because this is an artificial problem created from external factor, nothing related to domestic factors.
Of course, energy prices will be key to watch. But speaking specifically of India, if you could just shed some light on why nominal GDP growth in local currency, how does that basically create a false sense of financial security? Now, India's GDP numbers in rupees look fantastic, nearly doubled where they were 7 years ago. But in terms of dollars, growth has halved. So for an ordinary viewer, why should they care about the dollar scoreboard if they earn and spend in rupees?
Then that is actually correct. In fact, I was just working on one of the article where we talk very interestingly about purchasing power parity. So if you compare the purchasing power parity with regards to Indian rupee in very simple terms, like if you want to buy a burger today in Mumbai from a McDonald's, the price of it is say 250 rupees. And the same if you convert it in Manhattan, the price would be anywhere between $6 to $7. So from a price to parity comparison, so how much does $1 buy for you? So 18 rupees, you would be 18.96 rupees, you would be able to buy the same thing that you buy for $1 in US. So from an Indian consumer perspective, it technically doesn't matter because your prices are adjusted to the local market. So you shouldn't be impacted by it. This problem occurs only for things which are imported. So when you bring, say, gold from outside the country, when you bring energy from outside the country, that's where all this chaos happens. But otherwise, if you see the GDP numbers also, India is not predominantly growing because of exports. It is a domestic consumption story, which is what is leading this growth number, which has surprised almost everyone in the market. Everyone had actually written off the growth numbers in India, and everyone had revised down to 6.9%. But the current numbers show that the economy is fairly strong. And one of the reason is we did not create a model which was like China, where you're just exporting things outside the country and trying to bring growth from that. So it is to a great extent insulated, but at the same time, I don't say that we won't be affected by any crisis that happens externally because we do trade with the outside world. So it has an impact. So coming back to your question, if you are earning in rupee and spending in rupee, technically a fall in rupee should not impact you. In fact, it is good for exporters. All those who are exporting things outside India, your export has become cheaper. You've become more competitive to sell your textiles or jewelry or whatever you're trying to export. It has become more competitive as compared to other markets. The only problem in this is if you're relying too much on import, then you have a problem. But I think we are way crossed that level because we have a comfortable reserves of $696 billion dollars, and our current account deficit is hardly 1% of the GDP. So it shouldn't matter. This is a temporary problem, though. One of the reasons why rupee is also under pressure is you need dollars immediately, and which is why you would see that the RBI has also come up with increasing interest rates for NRI deposits. So this is a temporary problem which
Right.
is caused in the market, and it should get fixed over a period of time automatically.
Okay, but like you were saying, a weaker rupee does help some of the exporters. But how much of an edge do you think do they have at this point in time, given that shipping routes are disrupted? They could export a lot and maybe make higher profits, but are export routes open enough for them?
Yes, in fact, most of the goods that we export are to Europe and to US. The current disruption that has happened is more for the energy that we bring to the country, especially the liquefied natural gas from the Middle East. But otherwise, from an export perspective, the routes are not disrupted. It's the cost part which has really gone out of the budget because, as you know, that the energy prices goes up, everything goes up. So
Correct.
this has made a little challenging for all the exports that are going out of the country in terms of a higher freight cost.
Right.
Also, many things that you're exporting through airlines, even they get impacted because airfares have also gone up.
Exactly. So I was just going to ask, is it at all possible to protect those margins?
Technically, one of the reason why I don't say that the government is doing it deliberately, but I mean one of the way by which the government is trying to, you could say, defend it is by allowing the rupee to fall. Because if my cost has gone up by 5%, I'll make my product price go up by 5%. But if allow my currency to fall by 5%, so it gets offset, technically. So if you see last 1 year depreciation in rupee, it's close to 11.5% or 11.59%. So it is actually given a cushion to all those exporters who are now bearing the brunt of higher cost and other things. In terms of market, Indian goods are still not become that expensive as compared to other markets, because also I would say that Indian currency has also been the worst performing. So we have fallen more than the others, which probably has also, you could say, a blessing in disguise for exporters, because it has protected their margins.
Okay, okay. But let's talk more about the economy there. Now, we are hearing that India's dream of becoming that $5 trillion economy, that's being delayed because of the rupee fall. That's about 10% in a single year, 11.5 is what you were pointing out. How did a falling currency completely wipe out the domestic economic gains?
Yes. So in dollar terms, we have suddenly, become from the fourth largest economy to the sixth largest. And I wouldn't say it has slowed down, but it has made it more challenging. So from a structure perspective, I am sure that the government has to do something more, just like when the tariffs were introduced, GST reform was something which came in. So to overcome this and still meet the $5 trillion target in a given time period, the government has to again push on reforms, make things simpler for businesses domestically, and the government does have legroom in terms of spending domestically. If not spending, also giving some incentives. So like just like for data centers, how they have said that for 20 years there's no tax. By the way, something similar was also done 10 years back by Vietnam, where they said there's no tax on chip making, and suddenly in 10 years you see they have become one of the largest makers of chips. So you may not have to actually shell out any money right now from government's, kitty, but come up with some reforms which will allow foreign money to come and get invested in India in the form of FDI, not FII. FII money goes in the markets, which is short
Right.
term, but bring money in terms of investments, which will stay longer in the economy, and it will also help the economy grow in long term.
Okay, so that's about the FDI reforms that, if they come in, would help the economy. But when the rupee loses value against the dollar, how does it directly translate into higher prices for everyday things like electronic gadgets, fuel, or a family's household budget, basically?
Right. So as I mentioned that anything that you're importing from outside the country is going to become expensive. So whether you talk about gold, whether you talk about energy, and for energy you need to understand that when crude oil prices or gasoline prices go up, it's not just that price. It has a ripple effect in terms of inflation. But you would see that it is again very surprising if you see the RBI data which was shared, a week ago from the MPC. The consumer price inflation has gone down from 3.1 to 2.9. So technically things should become more expensive, but I think this is also because the government did not change the price of fuel. But now that the price of fuel is changing, over a period of time, you will see prices of groceries and other things go up a little bit. Because you should keep in mind that the government has not really changed fuel prices dramatically. Like maybe in other Southeast Asian countries, the prices have gone up by 50, 60%. And here you may have only, 5 or 6% increase in prices. So this may not really have a very big impact, but yes, things will become expensive in near term in terms of day-to-day life. Your budget kitty may get come under pressure. By at least 5 to 6%, things may become expensive.
Okay, noted. Dr. Bhatt, thank you so much for joining me on WION today and helping us with all of those insights.
Thank you.
Great.
Thank you.
Well, from an India standpoint, growth doesn't mean much if the rupee loses its buying power on the global stage. And global conflicts will continue to dictate local prices. That's the big takeaway today. And to our viewers, what are your thoughts on the currency trap? Let us know in the comments below. Thank you for watching.